Okay, so we're going to talk about the role of banks in creating money. And in order to do that, we just need to have a little bit of an idea of what a balance sheet is. And a balance sheet measures what a firm owns, right? The things that it owns and what it owes to others. So we call what a firm or person owns its assets. We call what it owes to others its liabilities. And we write the assets on the left and the liabilities on the right. And the net worth, then, how much the firm is worth, how much the person is worth, is just assets minus liabilities. One thing to remember is if you borrow $100, that doesn't change your net worth because now you have an extra $100 that you borrowed, but you owe it to somebody else, and so your net worth is the same. Sometimes balance sheets are called T accounts because you make a T and you put the assets on one side and the liabilities on the other. So this is just something to remember. We got assets here on the left, we got liabilities on the right, and then net worth we put on the right just so it, well, balances. So here we can look at, for instance, just a person's balance sheet, right? So if Julia has $58 in cash and she has a loan of $58, then her net worth is zero. If she uses that $58 to consume, then now she has no cash, right? She ate it. Well, she didn't eat it, but she turned it into something she ate. She still has to pay back that loan, and now her net worth is minus $58. So if she gets $100, right, and she owes $64, this is just another example, then her net worth is 100 minus 64, or 36. And if I move myself a little bit up here, we can see, after she consumes, if she consumes $36, then she still has 64, which she owes in the loan, and so her net worth is zero. So that's just an example. A bank's balance sheet is a little bit more complicated. Banks are actually somewhat complicated entities. And so a bank is a firm that makes money by borrowing money and lending money. Now, we don't necessarily think of it as borrowing because often most of the bank's borrowing is in terms of deposits. But when you give money to a bank to deposit into your account, you're basically lending money to the bank because it's going to use that money in order to lend it to someone else and make a profit. And so we're going to talk about how that works. The central bank in a country is the one that is in charge of regulating the banks and is the one that can create a legal tender, right? So we call this base money, sometimes high-powered money, and it's going to be the cash that's in the system plus what we call reserves. And so reserves are going to play a central role, which you might guess since our central bank is called the Federal Reserve Bank. Bank money is money that gets created by banks. Now, it's not going to look any different than base money necessarily, but they're going to take deposits, right, from their depositors, keep some in reserve, and then lend out the rest. And by doing that, they're actually going to create money. And so what we're going to call broad money, which is sometimes in the United States called M1, is just going to be base money plus bank money. M1 usually wouldn't include reserves, so it would just be cash and checking accounts, and then usually traveler's checks, but nobody uses those anymore. So let's think about the banking system for a little bit. So the interest rates are going to be really important for what's going on, right? And so there's going to be a couple interest rates that we want to think about. One is going to be the policy interest rate, and that's going to be the interest rate that the central bank sets. So every 5 or 6 weeks, the Federal Reserve meets and decides what they want the interest rate to be. What in this case is called the federal funds rate, and then the discount rate. Those are the two policy interest rates that the central bank targets in the United States. That's going to be related to the bank lending rate because banks will have access to funds at that federal funds rate, at that policy interest rate, and then they're going to lend out money at a higher interest rate in order to make a profit. So commercial banks are here in the middle. They're going to have reserve accounts with the central bank, right? That's our Federal Reserve Bank, which in this case, in the United States, is there's 12 regional Federal Reserve banks spread across the country, and then there's a board of governors in D.C. Savers, right, people who want to save their money, are going to put their deposits into the commercial banks. Those commercial banks are going to put some in reserve at the central bank, and then they're going to lend out money to people who want to borrow, right? Here are our borrowers over here. And then this money market is one in which big firms generally borrow and lend money directly, and that's the money market. And you can also, savers can lend money in the money market by buying government bonds or even corporate bonds, things like that. So a bank's balance sheet is a little bit different than a regular firm's balance sheet because it's all about financial assets. And so from the liabilities side, the biggest liability is going to be bank deposits. So when you deposit $1,000 into the bank, that's your money, right? The bank needs to give it back to you whenever they ask. And that's why it's often called demand deposits, and that's for checking accounts. Savings accounts are a little different. It's still your money, but they don't have to give it back to you right away, which is why you might get a higher interest rate on a savings account versus a checking account. But big banks will also have a lot of other liabilities, right? They'll have borrowing from other banks. They'll have unsecured borrowing. And so they're trying to get a lot of liabilities because the way they make a profit is by taking those liabilities and then lending them out. And so if we think about what their assets include, well, it includes base money in terms of especially reserves that they have at the central bank. It includes loans, right? That's their biggest asset. Bank loans to car buyers, to home buyers, to businesses. And they're charging a higher interest rate than they're paying on their liabilities, and that's how they're making a profit. It's also going to include government bonds, corporate bonds, etc. And then, of course, they will have their physical assets, things like buildings. And their net worth is the same as any other firm. It's going to be their assets minus their liabilities, right? And that's called their equity. Now, leverage is going to be really important to banks because the higher the leverage, the more profit they can make by turning those liabilities into assets. And so the leverage ratio is how many assets they have divided by the equity stake. So, most firms that create goods and services will have a much lower leverage ratio than will banks. Banks want to increase their leverage ratio as high as possible in order to turn those liabilities into profit. The problem is that the higher is the leverage ratio, the riskier it is, because if those assets lose value, for instance, if people stop paying their mortgages back and so those mortgages become useless, then the liabilities can be worth more than the assets, and that's when a firm goes out of business. And that's really what happened in the financial crisis was those assets that banks had, especially based on mortgage-backed securities, fell in value, and nobody would buy them until the Federal Reserve stepped in and started buying them. So let's do a quick example about how banks create money. So let's say Marco has $100 in his checking account. Put myself down here again. So the bank has $100, which Marco put in, but they owe $100 to Marco, right? That's his money. Now, if Marco goes and pays $20 to Gino, right, writes a check, then his checking account falls by $20. Abacus Bank, which is Marco's bank, sends $20 to Bonus Bank, which is Gino's bank, and now they have $20, but it's in Gino's checking account. So far, nothing has changed in total. We're still at $100 on each side. But now, what if Bonus Bank gives Gino a loan of $100? Well, okay, now they have another asset. They have a loan of $100, but they have to give that $100 in cash to Gino. So their liabilities increased as well. But by creating that loan, they've actually created more money. Gino's checking account has increased by $100 because of that loan. Now, if Gino then goes and pays Marco $10, Now Marco has $90 in his account. Abacus has $90 in cash, and Gino now has $110. And Bonus Bank has $10 of base money, $100 that Gino owes to them, and so $110 in total assets. The key here is that the total money in the banking system has grown, right? It's grown from $100 that we had at the beginning to $200 that we had at the end, and that was all through the loan that that Bonus Bank made to Gino. And they were able to do that because of the deposits that Gino had made. And so the key here is understanding the role that reserves play. And so as long as banks have enough reserves, they're able to make out loans, and increasing loans increases the money supply. And the central bank will tell the banks how much reserves they have to have. And the fewer reserves that are required, the more they can lend out, the more the money supply can increase. And the more reserves that are required, the less they can lend out. And so this is called fractional reserve banking, and it allows banks to turn small amounts of money into larger amounts of money for the economy. The problem is that in this case, Bonus Bank only has $20 worth of base money, right? But they owe $120 to Gino. Now, there's only one customer here, right? And so usually if you multiply this by 1 million customers or 10,000 customers, it wouldn't be a problem, because some customers would ask for some money back, some customers would put money in. But if Gino comes right now and says, I want $50, Bonus Bank is not going to have enough. They have enough assets, but they can't turn it into cash. And so that's going to be the problem. So we can look at a sort of simplified bank's balance sheet. Here, let me move myself over so we can see the equity. Banks are going to have, on their asset side, they'll have some cash and reserves, right? So what's sort of immediately available to pay out to depositors who want their money. They'll have some financial assets, things like government bonds, which they can use as collateral to borrow. They'll have some loans to other banks. They'll have loans to households. And they'll have some fixed assets. So this is an example. It shows you that the financial assets here, right, the loans and really government bonds are just loans too, make up, almost all of their assets. In this case, 96%. Their cash and reserve are only 2%, and their fixed assets are only 2%. Now, I should say that in the United States, banks have to keep about 10% of their deposits in reserve, whereas in Europe, the requirement is much lower. So that would be a higher number in the United States. That said, they have less capital, right? So one of the roles of central banks is to sort of organize and agree on similar requirements for big banks so that they can compete on similar levels. On the liability side, the bank has about 50% of deposits, 30% of secured borrowing, meaning borrowing from other banks that maybe, for instance, they have collateral from the government bonds, and then 16% unsecured borrowing. And so their net worth, their total assets minus their total liabilities, is only about 4, meaning that in this case, assets divided by equity, or the leverage ratio, is about 25. And that's just a whole lot higher than you would see for a firm that makes cars or clothes or food. They're going to have, a much lower leverage ratio.